Good evening and welcome to the Economic Desk. Tonight's developing story is moving faster than markets can price, and the clock has already started ticking. In what analysts are calling the most aggressive material shock in over a decade, China's abrupt export ban has triggered a 26-fold surge in global delivery requests within just hours, and logistics pipelines worldwide are now stretched beyond capacity. If you've been sensing tension in commodities or hearing whispers from manufacturing hubs, this isn't noise, this is the sound of a system reaching its breaking point. As we speak, major economies are racing to secure supplies before the next shipment window closes, and market insiders say we may have less than 36 hours before inventories begin to dry up, triggering price spikes that could echo 2021's bottleneck, but with far sharper edges. What makes this moment particularly volatile is not just the ban itself, but its timing and target. The restricted materials aren't consumer goods. They are industrial inputs at the foundation of defense technology, semiconductor production, and renewable energy infrastructure. These are not products you can substitute overnight. European manufacturers are reporting overnight order books that look more like panic buying than strategic planning, and early data shows bids arriving faster than warehouses can process them. One logistics executive described the rush as an explosion we did not have the systems to absorb. The implications are straightforward yet alarming. Factories may soon halt, supply chains could fracture, and inflation, thought to be cooling, could catch fire again. The global economy is playing chess while the clock is ticking down, and right now, every move counts. Investors are reacting like they've seen this movie before, but this script has new characters. Hedge funds are repositioning into commodities with a speed that suggests they're not preparing for volatility, they're preparing for scarcity. Futures markets in metals and key industrial minerals have already widened spreads to levels not charted since the energy crisis, while shipping brokers warn that insured transport corridors could become auction-based within the week. The psychological shift is just as significant. What began as a policy adjustment by Beijing has evolved into a signal of strategic leverage, and markets are responding as though the era of predictable globalization has reached a breaking point. But the deeper issue is the time horizon. 36 hours. That's the period credit analysts are using as their benchmark before delayed delivery confirmations trigger supply-side defaults. If those defaults stack, we could see forced liquidations in industries already under debt pressure, particularly small to mid-scale manufacturers who rely on just-in-time inventory. The domino effect could jump borders quickly. If assembly lines slow in Shenzhen, expect delivery complications in Berlin, bidding wars in Chicago, and revised procurement strategies in Seoul, all feeding back into the markets investors claim they're ready for, yet visibly are not. We are exactly 36 hours away from the moment the world changes. In 36 hours, the sun will rise on January 2nd. The holidays will be over and the China export ban will become active law. But we do not have to wait for Thursday to see the damage. The damage is already here. For the last 48 hours, we have been warning you about a bifurcation, a splitting of the market. Well, today, that split became a fracture, and that fracture just became a chasm. Ladies and gentlemen, Asian guy here, known as John, AG from Currency Archive. As I speak to you right now, there is no longer a single price of silver. The global market has shattered into three distinct realities. And if you're looking at the price on your banking app or your standard news terminal, you're looking at the wrong reality. You're looking at a ghost. Let's look at the three-tier market that has emerged this afternoon. Tier 1 is the panic price. This is the price in Shanghai. The Shanghai Futures Exchange closed its final session of the year at an equivalent of 84.55. This is the price being paid by the manufacturing capital of the world. This is the price being paid by the entities that actually consume the metal. They are desperate. They are running the ban and they are paying whatever it takes to secure inventory before the doors lock in 36 hours. Tier 2 is the physical price. This is the price in the Middle East, specifically in the UAE and Dubai physical soaks. We have confirmed live transaction prices averaging their 79.61. This is the honest physical market. It is not in a total panic like China, but it is tight. It is demanding a premium. It is telling us that even outside of the export ban zone, physical silver is trading nearly 8 higher than the paper spot price. And then we have Tier 3. Tier 3 is the zombie price. This is the comic spot price in New York, It is currently trading at 72.15. Do the math with me. 184.55. In Shanghai, the 72.50 in New York, that is a spread of WOV 1240. That is a 17 2-cent premium. I want you to understand how impossible that number is. In a functioning global economy, a spread of 17% on a fungible commodity, like silver, is illegal by the laws of physics. Arbitrage traders, the banks, the hedge funds exist to close that gap. If they could, they would buy every single ounce in New York at 72 and sell it in Shanghai at 84. They would make risk-free billions. But they aren't doing it. The gap isn't closing. In fact, it widened from 1,000 yesterday to 112.40 today. Why? Because the arbitrage is dead. The traders know that they cannot move the metal. They know that the January 2nd deadline is a hard wall. They know that if they buy silver in New York today, they cannot physically ship it, clear customs, and land it in Shanghai before the licenses go active in 36 hours. The bridge has been burned. New York is an island of paper trading, stranded in a sea of physical shortage. So, when you see 72.15 on your screen, realize that it is a lie. It is the price of a paper contract that nobody wants. The real world, the world of factories, solar panels, and strategic reserves, is trading at 84.55. That is the real price. The fact that the paper market is lagging by 12 tells you that the COMEX has lost control. It is no longer the price setter. It is the price suppressor. And the physical market has finally decided to ignore it completely. But the spread is only the symptom. The disease is much, much worse. Because while the price is broken, the volume is exploding. We just got the delivery data for today's session, and it confirms our worst fears. Yesterday, we saw a vacuum operation in China. Today, we are seeing a run on the bank in New York. The delivery volume hasn't just gone up, it has gone vertical. We are talking about a 26 times increase in physical demands in a single day. Let's look at the delivery spike that is draining the COMEX dry. Do you remember yesterday? In our last alert, we mocked the COMEX volume. We pointed out that out of billions of paper ounces traded, only 69 contracts stood for delivery. That is a paltry 345,000 ounces. It was a joke. It was evidence that the market was purely speculative. But today, the joke is over. We just received the preliminary delivery notices for the December 31st session. The number of contracts standing for physical delivery has exploded to 1,847. Let's do the math on that. 1,847 contracts times 5. 1,000 equals 9,235,000 ounces, 9.2 million ounces demanded in a single day. Compare that to yesterday, 345,000 versus 9,200,000. That is a 26 times increase in physical demand in just 24 hours. This is not a pickup in volume. This is a raid. This is a panic event. It means that nearly 2,000 large entities, banks, funds, industrial giants looked at the calendar, saw January 2nd approaching, and hit the deliver button simultaneously. China's sudden export ban did not just ripple through global markets, it detonated beneath them, sending governments, manufacturers, and traders scrambling in real time. When the world's largest supplier of strategic industrial materials turns off the tap overnight, the impact is instant and unforgiving. What looked like a routine geopolitical maneuver has now escalated into a direct supply shock with the power to reshape production pipelines from Seoul to Stuttgart and from Texas to Tokyo. And the most pressing question reverberating through boardrooms today is simple: what happens when the world's factory stops supplying the world? The silence is deafening. Within hours of the policy announcement, procurement desks were lit up like emergency rooms. Phones rang nonstop, emails flooded in, orders doubled and tripled, not because demand grew, but because fear did. The psychology of markets is not driven by logic in moments like these, it is driven by the terror of running out. And as suppliers, traders, and insurers processed the ban, price quotes began shifting upward minute by minute, like an elevator that won't stop rising. Companies that once negotiated payment terms are now begging for availability at any cost, hoping to secure even partial shipments before inventories run dry. Can you imagine the pressure on executives responsible for maintaining supply when the faucet shuts and there's no backup plan? The core of the shock lies in China's position not merely as a supplier, but as the supplier. For several critical metals and components, especially those vital to high-tech manufacturing, energy storage, and military applications, Chinese exports represent the difference between production and paralysis. Western economies have long acknowledged this dependency, but rarely confronted it. Now, with the clock ticking on pre-existing stockpiles, A countdown has unofficially started. How long until assembly lines stall? Analysts estimate that major manufacturers could face material shortages in days, not weeks, if the ban persists. The vulnerability isn't theoretical anymore. It's unfolding hour by hour. Markets thrive on predictability, but this event shattered expectations. Traders are no longer asking whether prices will rise. They are assessing how violently. Every shipment withheld tightens the news on supply chains calibrated for efficiency rather than resilience. For years, globalization rewarded low inventory and rapid turnover. Today, those same strategies threaten to become liabilities. What seemed like smart optimization suddenly looks like reckless exposure. A single export policy decision has pulled back the curtain on how fragile global production truly is. And as the world recalibrates, one unavoidable truth stands out. When the anchor of global supply shifts, every economy drifts with it. China's export ban did not just disrupt trade flows, it accelerated an already brewing demand surge into what can only be described as a delivery explosion. The numbers tell a story of urgency. In just hours, delivery requests jumped by more than 26 times their normal volume, overwhelming logistics networks and exposing the uncomfortable truth that global supply chains are stretched far thinner than anyone wanted to admit. What triggered this frenzy? The realization that once locked supplies are gone, they may stay gone, forcing every buyer to secure materials now or risk being priced out entirely later. It's the type of panic that separates companies that prepared from those that simply hoped for stability. And in today's environment, hope is not a strategy, it's a liability. The surge in delivery demand is more than a statistic, it's a window into shifting power dynamics. Historically, suppliers competed for buyers. Today, buyers compete for suppliers. Manufacturers, refiners, even national stockpile managers are pushing forward orders at breakneck speed, trying to get on the priority list before capacity maxes out. The logistics sector, long accustomed to predictable seasonal cycles, is now adjusting to military-style urgency, planes chartered at premium rates, ships rerouted mid-voyage, trucks dispatched without return loads simply to shave hours off delivery time. One logistics executive described it as Black Friday for raw materials. Except this time, missing out doesn't just cost money, it costs market survival. When delivery windows shrink, competitors don't wait, they pounce. What makes this spike especially alarming is that it reflects demand pull, not speculative hype. Manufacturers are not stockpiling out of greed. They are stockpiling out of necessity. Factories cannot operate on empty shelves, and production schedules months ahead depend on securing materials now. Every delayed shipment is a delayed product, and every delayed product is lost revenue. That urgency cascades through entire sectors. Renewable energy installations face delays, electronics producers struggle to maintain assembly pace, defense contractors raise alarms about national readiness. And as delivery requests pile up, the price of being at the front of the line rises daily. Today's premium becomes tomorrow's baseline. Anyone waiting for lower costs is likely waiting in vain. Yet beneath the rush hides the most provocative question: what if this surge isn't temporary? If the export freeze extends, the 26x spike may not represent panic, it may represent a new normal. In that scenario, delivery guarantees become as valuable as the materials themselves, reshaping trade relationships in real time. Once, globalization taught companies to optimize for speed and cost. Today, the lesson is shifting toward control and certainty. Whoever secures timely delivery controls production, pricing power, and ultimately competitiveness. And in a world where supply chains are turning into battlegrounds, one thing is clear: speed is no longer just an advantage, it is survival. The depletion of global inventories is no longer a distant warning written in academic papers. It is unfolding in real time, and the clock is ticking louder with every redirected shipment. What makes this moment so dangerous is not simply that supplies are tightening, but that the world spent the last decade running inventories dangerously lean, convinced that, just in time, logistics would always deliver. Now, with China's export restrictions acting as a supply choke point, shelves that once served as buffers have shrunk into thin safety nets. And here's the hook that should make every policymaker and business leader lose sleep. The smaller your inventory cushion, the faster your vulnerability becomes a crisis. Companies that once viewed inventory as an expense are suddenly realizing it was insurance, and they let their policy lapse right before the storm. The evidence is visible across sectors. Manufacturers accustomed to weekly or monthly deliveries are now placing quarterly buy orders, not to expand production, but simply to keep assembly lines moving. Semiconductor plants, renewable energy suppliers, and even medical device makers are counting components like rationed goods, each shipment treated as precious cargo. Procurement managers who once negotiated price are now negotiating survival, asking a single urgent question: can you guarantee supply? And in this climate, suppliers with stock rarely say no, but they do name their price. What used to be a buyer's market has flipped with brutal efficiency. When inventory dries up, pricing power shifts instantly and dramatically. Those on the outside looking and discover too late that markets do not wait for anyone. Behind the scenes, inventory depletion is forcing strategic recalculations that were unthinkable only months ago. Governments are quietly reviewing national reserves, mining companies are accelerating output targets, and corporations are dusting off contingency plans written during past crises but never used. This is no longer about cost efficiency, it is about economic resilience. The companies that last longest in a crunch are those that moved early, securing materials not just for current production, but for the uncertainty ahead. Those who delayed, believing the disruption would fade, now face crushing lead times and dwindling warehouse space filled with everything except what they actually need. And here's the deeper implication. Once inventories fall below stabilizing thresholds, recovery doesn't happen smoothly. It happens painfully, slowly, and at a premium. The hidden danger is the chain reaction waiting to ignite. As inventories dip, production stalls. As production stalls, revenue shrinks. As revenue shrinks, debt burdens become heavier, and when debts can't be serviced, markets tremble. Inventory is not just material, it is momentum. Lose inventory, and you lose the ability to project stability. Lose stability, and you invite panic. And once panic takes hold, the market doesn't correct gradually, it breaks suddenly. The question is no longer whether inventory depletion matters. The real question is how many industries are already closer to zero than they dare to admit, and how quickly the world discovers which ones hit the wall first. Liquidity strains have a way of revealing themselves, quietly at first, tiny cracks that most observers dismiss as noise, until suddenly they widen into fractures large enough to swallow entire balance sheets. What makes the present situation so alarming is not that liquidity is vanishing overnight, but that the structural support that once absorbed shocks has already been thinned out by years of leverage, refinancing, and financial engineering. The hook many still refuse to grasp is this: when liquidity disappears at the same moment supply chains tighten, the economic system loses both fuel and oxygen. What follows is not a slowdown, it's a stall. And stalls don't correct gracefully, they drop like a stone. Credit markets are flashing signals that used to require a crisis to trigger. Corporate refinancing windows are shrinking as lenders prioritize only the safest borrowers, pushing smaller and mid-tier firms toward higher-cost private debt markets. These firms are already operating with reduced inventories and elevated input costs. Good evening, every extra percentage point of interest cuts deeper than before. Tonight's developing story is moving faster than markets is not just a financial metric. The clock has already started. An operational constraint. And what analysts are calling when companies can't roll their debt. The most aggressive material shock in over a decade. When they cut spending, China's abrupt export ban has triggered a 26. When orders fall, suppliers and global delivery requests within just hours. Prices destabilize pipelines just as worldwide are now stretched beyond capacity, amplifying the shock across sectors. If you've been sensing tension in commodities as a credit issue, or hearing whispers from manufacturing hubs, the compounding this isn't noise. Even more this is the sound of a system reaching its breaking point, where liquidity is increasingly weaponized through major economies are racing to secure supplies, interest before the next shipment window closes, and export controls. And market insiders say we may have less than 36 hours corporations before inventories begin to dry up. Domestic priorities override global that could echo 2021's flow of capital becomes as restricted far sharper as the flow of raw materials. What makes this moment investors who once relied on not just liquidity cycles, but its timing are now asking an uncomfortable question. Restricted materials are consumer goods. Money doesn't flow back. They are industrial inputs at the foundation of defense technology, markets, but caution semiconductor production. And renewable caution dries up liquidity just as efficiently as these are not products only with less noise overnight. And fewer headlines. European manufacturers are reporting overnight order books that holding leveraged positions look more like especially those tied to commodities and interest. And early data shows bids arriving faster than warehouses becomes a calculation of survival. One logistics executive described the rush as shadows silent, an explosion we did not have the systems to absorb. The moment liquidity
the implications
becomes
are
scarce,
straightforward yet
forced
alarming.
selling begins. Factories may soon halt.
Investors want to sell.
Supply chains could fracture
because they have to.
And inflation, forced selling, does not wait for fundamentals.
Catch fire again.
It obeys only the clock. The global economy is playing
liquidity
chess
remains
while the
constrained,
clock
while
is ticking
inventories
down.
stay thin,
And right now,
markets
every
won't
move
just
counts.
wobble.
Investors
They
are
could hit an
reacting
air
like
pocket
they've
with
seen
no
this
buyer
movie
underneath.
before. But this script
The
has
danger
new
isn't that
characters.
liquidity is disappearing all
Hedge
at once.
funds are repositioning into commodities with a
where it
speed
matters
that
most.
suggests they're not preparing
Faster
for
than most
volatility.
realize.
They're
and with
preparing for
consequences
scarcity
that could rewrite valuations.
Futures
across the
markets
board.
in metals and key industrial
Geopolitical
minerals
tensions have always
already
influenced
widened spreads
markets.
to levels not
But what's
charted
unfolding
since
now
the
is
energy
less
crisis,
about rivalry
while
and
shipping
more about
brokers warn that
retaliation.
ensured transport
Strategic
corridors
recalibration
could become
of economic
auction.